First, Ray Dalio foresaw the 2008 financial crisis. Then, he predicted years of long-term financial strain on the US economy from the COVID pandemic. And now, the 73-year-old billionaire investor has warned of a new economic catastrophe on the horizon, which is worse than the coming recession. Dalio said that his predictions aren't facts, and he's been wrong before. His future catastrophes are inevitable, according to historical patterns over the last 500 years. What did the legendary investor Ray Dalio say that is worse than a recession? In this video, we'll be talking about it, and also tell you 2 amazing tips that Dalio gave to combat the problem. But before I start, make sure to like the video and subscribe to my channel for amazing upcoming content. The legendary investor said the stock market has further to fall before a recession hits. And with the Fed making its third 75 basis point hike last year, greater economic contraction is on the horizon. For much of the previous year, the Fed has held steadfast to its goal of a soft landing for inflation, which is the idea of vanquishing inflation without a dramatic economic downturn. But despite several interest rate hikes, inflation is still there. And business leaders are saying that it's not a matter of if a recession will happen, but when. Last year, after another rate hike and a promise from Fed Chairman Jerome Powell to stay the course until inflation comes down, Dalio said that the Federal Reserve will probably keep tightening its monetary policy until high prices come down, no matter the consequences. And as a result, a recession is likely within 2023. The classic early signs of contraction in the housing and auto sectors, which are the first to be impacted by the Fed's higher interest rates. In June 2022, he argued on LinkedIn that a soft landing was out of the Fed's reach, even as Bridgewater beat the bear market in the first half of the year, delivering a 32% return to investors as other firms struggled. Dalio's comments followed the Fed's decision to institute its third consecutive 75 basis point rate hike last year. Before June, the last time the bank had made such a big rate hike was in 1994. Dalio said the hikes have already slowed down economic growth significantly in the US. After the Fed's rate hike, the S&P 500 fell 1.7% to a 2-month low. Dalio said that the stock market will sink further as the Fed continues its hikes, adding that the bond market will be hit particularly hard. Meanwhile, Federal Reserve Chair Jerome Powell said that the central bank will stop at nothing until inflation is under control, even if it means some pain to households and businesses. Dalio said that the pain will be sorely felt over the next few years, and the Fed always has a trade-off between economic strength and inflation, with inflation now the bank's target. It will chart a course until economic pain is considered more severe than inflation. He also outlined how cash-strapped governments loaded up on debt while money was cheap and plentiful, but now rising rates are increasing their borrowing costs and threatening to plunge them into fiscal crisis, further saying that now an interest rate that is high enough to deal with inflation and also high enough to provide an adequate return for the bond investors is too high of an interest rate for the debtor. The Bridgewater founder described Britain's recent market meltdown as a canary in the coal mine, saying that he expects other countries to try fighting inflation with higher rates, while also shoring up growth through debt-funded spending. Yet the UK's experience shows that the approach can spook investors, spark liquidity and leverage issues, and prompt emergency interventions from central banks. Dalio also skimmed on how a US recession could materialise. He predicted higher yields on super safe government bonds would sap demand for riskier assets such as junk bonds, and tighter financial conditions would leave consumers, companies and other entities short of cash within the next few years. The fight to have assets, coupled with the liquidity crunch, would likely drag down financial markets and weaken economic development. He expressed that the dominoes are falling in a very classic way, and said that he sees the classic early warning signs of a recession and expects the economic picture to get worse over the coming years. The Bridgewater Associates founder said that given rising interest rates meant to tame record high inflation and other factors like Russia's invasion of Ukraine rattled energy markets, the US economy has more room for further pain. Dalio thinks that it's going to get worse in 2023 and 2024. which has implications for elections. He also said that we are very close to 0% growth right now, and pointed out some key red flags, like drawdowns in cash balances that had been built up earlier, contraction of both the housing and automotive sectors, and the rising credit delinquency rates. The central bank has remained consistent in its messaging that Fed prioritizes reining in inflation back down towards its 2% target over economic growth. Dalio said the Fed has a trade-off between supporting the economy and controlling inflation. He said that they would tighten monetary policy and take away credit until the economic pain is greater than the inflation pain. So here are Ray Dalio's top 2 tips to combat the problem and financially prepare for it. Number 1. Assess your financial risks. Regardless of what happens, a simple principle for approaching future events is that if you worry, you don't have to worry. And if you don't worry, then you have to worry. He said worrying prompts you to take a close look at your own personal risks and encourages you to take action on them. Also, he advised to measure financial risks in inflation-adjusted terms instead of today's dollars. For example, if you have cash in saving accounts, it's probably accruing value at a different rate than your other investments since it's being taxed by inflation. But that doesn't mean you should solely choose other investments over a savings account. Amid chaotic times, you need your emergency savings to be funded by a safe, well-diversified portfolio. Number 2. Save and diversify your portfolio. Dalio's first step to a strong portfolio is assessing your current investment strategy to figure out how many weeks you could financially survive if you lost your job, and then make sure your money isn't all in one place. According to Dalio, cash is not a safe investment. Instead, he suggests building as diverse a portfolio as possible, ranging from inflation-index bonds to physical assets like gold. Your portfolio could either include digital investments like cryptocurrencies. Dalio personally owns a small amount of Bitcoin, despite years of criticizing crypto, saying it's a hedge bet made solely for the purpose of diversification. So that's all for today, guys. What do you think about Dalio's warning and approach? Let me know in the comments. Make sure you give this video a thumbs up and subscribe to my channel so you don't miss out on fantastic financial content. Until next time.